Today's sell-off, let's welcome in Kevin Mahn, the Chief Investment Officer at Hennion and Walsh. Kevin, it is good to see you. So listen, let's start there. You know, as you heard us, Kevin, we're trying to, this stock rotation we're seeing together has a lot of people talking, and we're trying to figure out if what you see here today, big tech slipping, but listen, those interest rate sensitive sectors, they're working, Kevin, small caps cashing a bid. You think it's a one-day move, or no, this is something bigger, it's broader, it's going to stick?
Yeah, Josh, I think the rotation out of large cap technology stocks may have begun today. And that rotation is going to be led by cuts in interest rates in addition to earnings growth beyond the Magnificent Seven technology stocks. And to put that into perspective, let's remember that over the course of the last 12 months, 83% of the earnings growth in the S&P 500 has been driven by the Magnificent Seven technology stocks. We also know that through the first 2 quarters of this year, the market was up by 15%. Pull out the Mag 7, it's only up 4%. Now, while that's an average year for the markets, it certainly doesn't sound as good as up 15%. So the market needs to see earnings growth from those other 493 stocks this quarter. And the good news is, according to FactSet, it's forecasting that earnings growth will reach around 8.8% in the second quarter. If that holds true, that's the best quarter year-over-year earnings growth since the first quarter of 2022.
The irony is, I couldn't help but thinking this, you know, if we 2 years ago had gotten a day when rates were dropping, when the yields were dropping, tech would have been up, right? So there's been this big sort of shift that tech is now a haven, which is sort of ironic. But I do wonder, as rates do start to come down, if the Fed does start cutting, will those companies also benefit? Will you continue to see this rotation, or will it just be a buy everything kind of market?
Yeah, the tech trade isn't dead by any means. And in fact, I think there's going to be years more of growth opportunities related to the AI ecosystem. But what areas of the market really haven't taken part in this rally that started in the beginning part of last year? How about areas like industrials, aerospace and defense, consumer staples, healthcare, and even utilities? No one's looked at utilities for the better part of the last 3 years as rates have risen. Guess what happens as rates come down? All of a sudden that utility that pays 4.5%, 5% looks pretty attractive again. And it's also another way to play the AI game, remembering that these data centers that power all these massive algorithms in AI, they rely upon utilities that supply the electricity solutions that they need. So I think there's another good way to play in those areas of the market that still are trading at attractive valuations, pay good dividends, can weather an economic slowdown, and will offer more upside, perhaps even more so than what we've seen from technology already. Not that you should trade out of your technology stocks altogether, but perhaps take some of your gains and redeploy to other areas of the market.
Yeah, I mean, utilities is interesting, Kevin, because we've got strategists come on, and they like utilities because they feel like you're kind of getting a little bit of offense and defense in that sector.
Also,
you heard Julie and I talking about small caps today too, which is interesting. I mean, there's sort of a big tech slipping a bit, but small caps catching a bid. Do you tell your clients, yes, you want to be in small caps here?
I believe you want to stay diversified. And a lot of clients out there right now who saw that through the first 2 quarters of this year, the market was up by over 15%. Last year, the market was up over 26%. And they were parked really in short-term CDs and treasuries earning 5.25% relatively risk-free. Smart way to play. But guess what? Add those two together, you've missed out on a pretty significant upside that's taken place in the stock market. My fear right now, Josh, those investors come off the sidelines. They look to move into areas of the market like large cap technology. They're going to get in at the highs, and they should consider being more diversified. Look to small cap, look to international, look to some of those other sectors that I mentioned as well. Have your allocations to large cap technology, include the Mag 7, but consider equal weighting as opposed to being market cap weighting.
I want to circle back to the earnings theme, because you and many others have pointed out that other 493 theme, that they're going to start to see earnings climb. Well, we got a trio of companies today in the form of Delta, Pepsi, and Conagra. And all of them, first of all, disappointed. But secondly, the theme seemed to be that the consumer is weakening. Not necessarily even just the lower income consumer, which had been the sort of conventional wisdom.
Yes.
How much of a concern is that?
It's been a concern of mine for a while, but we have to remember this is an intended consequence of all the rate hikes that the Federal Reserve has done over the course of the past, let's call it year and 3 quarters. 5 and 125 basis point higher on the short end of the curve. They're trying to cut demand by hurting the consumer. Here's the catch though. They forecasted unemployment to hit 4.1% by the end of this year. We're there already. They didn't forecast first quarter GDP growth slowing to 1.3%. I believe Chair Powell and the FOMC is now concerned that this economic slowdown may be progressing too quickly and while inflation is moderating. That's why I think 2 interest rate cuts are back on the table again, because we have an over-leveraged U.S. consumer, over $1 trillion in credit card debts, early delinquencies on those credit card balances, on auto loan balances are increasing, and also the federal government is also over-leveraged. You look at our debt to GDP ratio. So interest rates need to come down. And I think those earnings reports that we saw earlier today, I'll just focus on Pepsi to start. So my household, the Mahn household, is kind of split there. My daughters and my wife like Diet Coke, I like Diet Pepsi, but we all have a mutual admiration for Fritos.
You all get along.
We all like Fritos, right? Who doesn't like the great American corn chip? But what we saw from Pepsi today is that they missed on earnings. No, they beat on earnings actually, but they missed on revenues. And they also forecasted weaker revenues going forward because of weakness in the consumer. Boy, isn't that a telltale sign? Right? Weakness in the consumer. That's why I think the Federal Reserve is going to have to step in. I'm not going to play the guessing game. Will it be September before the election? But there are still 2 meetings after the presidential election. 1, 2 days after the presidential election. They still could cut 2 times this year. And if in fact that's the case, look for those beaten up areas of the markets to actually start to really perform.
Given your views of the consumer, and you're right, I mean, Kevin, we look at kind of the PepsiCo commentary on the consumer today. It was, talking about persistent inflationary pressures and higher borrowing costs and tighter household financial conditions, right? Does that inform how you want to put money to work in the market then? I mean, do you want to avoid middle income, low income, just stick to high income? How do you think about it?
I think you still want to build a diversified portfolio consistent with your risk tolerance. We often get the questions from our clients, the market is racing higher, I want to be more aggressive. Oh no, the market's trading off, let me be more conservative. That shouldn't be the case. You should build a portfolio consistent with your risk tolerance, what your goals and objectives are, and what your investment time frame is. Do you make tactical adjustments? Of course you do. In fact, we're equal weighted in terms of our exposure right now to those high growth technology stocks. We've added some exposure to artificial intelligence areas. We love data centers in this environment. We think that's the hidden gem within the AI ecosystem. We have money overseas. No one's talking about international stocks right now, but if you look at the EFI index, MSCI EFI, it's up over 8% during the first half this year. Emerging markets almost up 10%. So build a diversified portfolio, resist the temptation to try and time the market, and stay invested in the market.
Lots of ideas in there. I want to leave you on this, which is an election question, which I'm sure, we're going to be talking about this for the next several months, if not longer. Obviously, there's a lot of debate right now about whether President Biden should step aside as the Democratic candidate. There hasn't been really any market reaction to that debate. What do you think the reason is for that, and when do you think we might start to see some of that being felt more?
I believe the market is more focused right now on when that first interest rate cut is going to take hold, and if in fact this economic slowdown is going to dip into a recessionary territory. If markets are actually pricing in what's happened historically, remember that political parties have an impact on certain areas of the market, but generally not the market as a whole. In fact, history tells us that a divided government generally bodes best for stock market performance. That's because no major new rules or legislation or regulations get passed. I think that's what markets believe is going to happen coming out of this particular election as well. What we're talking to our clients about is build your portfolio consistent with the opportunities that we believe are in the economy right now. And once we know the outcomes of that election, then you could overweight or underweight certain sectors based upon the policies of those that are in power at that point in time. But don't let it sway all of your decisions. Don't sit on the sidelines waiting for the outcome of the political elections, because we know that trying to time the market is an exercise in futility. If you look back to 1990, if you just missed out on the 10 best days in the market, your returns would have been cut in half. I don't know when those 10 best days are. You don't know when those best 10 days are. But I can assure you, if you're not in the market on those 10 days, you're not going to participate.
I mean, look at the election in 2016, the market reaction that then was reversed. So
that was reversed. That's
you never know. All right. Thanks a lot.
My
Appreciate
pleasure.
it. Good to see you, Kevin.
You too.